Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, independent financial advisor and owner of Elevation Financial. As always, I'm really glad you're here. Glad you're joining me today. All right, today we're going to talk about gold, everyone's favorite shiny metal, gold. And should I invest in gold? This comes up a lot during periods of market volatility, market stress, when we're concerned about the market, when things are going down. This comes up a lot. This is a conversation that frequently surfaces, and that conversation centers around gold because many feel that it is a place to seek out or kind of a safe haven during times of volatility or times of market stress. So we're going to talk about gold today. And I want to preface this, as you may expect, by saying this is not specific advice. This is not going to end up telling you whether you should or should not invest in gold. It is meant, like in most cases here on this show, to help you think through it yourself, make a good decision based on the evidence and based on the discussion today. And ultimately, that's something for you to decide, or you and whatever advisor you might be working with to decide. So that's going to be the framing here. Where I'm not going to give you specific advice on what to do, but again, I want to talk through some points of discussion to help you think about it. So let's dig into gold. So first of all, why do people get interested in gold? This happens at many periods in the timeline, so to speak. At the time of this particular show airing, there's geopolitical conflicts, inflation. There's things happening that are causing market volatility and causing people to possibly have concern and generate stress about the market and stress about world events. It's natural for people to kind of search for safer investments during this time period, to kind of seek out safety. And so there are a lot of advocates that for gold specifically that believe that people should allocate a significant portion of their investments to gold. They often cite long-term returns and inflation protection as kind of the key points they like to point to when it comes to gold and its value. So those narratives being long-term returns and inflation protection are not necessarily supported by the evidence. The evidence that we're going to talk about today doesn't necessarily support that particular narrative. Again, I'm not saying gold's good or bad, or you should or should not invest in it, but I think it's important to understand the narrative and understand the facts behind it. So let's talk about some of the key points of gold and gold's returns specifically. So let's take a snapshot in time. So from January 1970 to December 2021, gold had an annualized return of 7.89%. So that's a time period people often point to when they talk about gold. They say, hey, gold has had a pretty decent return in that time period, 7.89%, not too shabby. However, let's compare it to the market in general, the global market, for example. Let's take the MSCI World Index, which is kind of a broad swath of global markets. In that same time period, the MSCI World Index was, 9.21%. So higher. Gold didn't do as well as the overall global market. Again, that's just the global market overall, not even just the US market, but just kind of a broad swath of the general global market of developed markets. So gold's price, or gold's return is again, it's lower than the global market, but still some would say not too shabby. It's still, almost 8% is nothing to be too concerned about. It's a pretty decent return. But let's dig deeper. When you look deeper and look at a very specific isolated incident, you'll find that there is one specific period of time that really drives this overall return in that time period. And that is the period between 1971 to 1974. And that's when US investors were unable to directly own gold because of government restrictions at the time. So during this time period, what would you expect to happen when the government restricts something? The demand for it goes up. This is sort of a natural occurrence we've seen in many different situations. But in this case, gold was restricted, demand went up, and in this time period, gold had an annualized return of 48.89%. So just shy of 50% return in this very specific isolated time period. So when you include that time period in that long track record of 1970 to 2021, that time period really helps bolster the perceived overall return of what gold did during that time period. But again, that very short, specific time period driven by a very specific, unique event really drove a lot of these returns. So if you take out that time period, if you just look at gold's annualized return between 1975 and 2021, it decreases to about 5%. So again, taking out that isolated, unique incident of government restrictions on gold, which drove demand through the roof, if you take that out and remove that from the picture, we see about a 5% return during more, I guess, more expected time period, or less volatile time periods, or without that specific gold specific type of event. So again, drops to about 5%. So many people also think of gold as a hedge against inflation. However, gold tends to be fairly volatile, to the tune of about 14 times more volatile than inflation overall. So gold's standard deviation about 19% compared to inflation's annualized standard deviation of a little over 1%. So we see a lot more volatility from gold. Additionally, the MSCI World Index, going back to that, that's less volatile than gold as well. So gold tends to have a high degree of volatility. Leslie is popping in on Facebook Live. So for those who, just a reminder, I do these shows on Facebook Live, and Leslie's popping in to say, but it's so shiny. It is, Leslie. Gold is shiny. We will talk about that, actually. I'm going to get to that in a few minutes. It's a great point. Gold is shiny. It is beautiful to some anyway. And that is a factor. So great points. We'll talk about that as well. So back to gold in terms of its value intrinsically as an investment. Gold doesn't pay dividends or interest. It doesn't produce those types of cash flows. Its only source of return is really the price appreciation, just caused by supply and demand. It's a speculative asset. It's really driven by the supply and demand. That's really its only factor of price. If you put gold in a vault and wait, it doesn't produce anything. It just kind of sits there. Its only value is the reflection of the current market price based on, again, supply and demand. And in fact, holding gold sometimes can incur negative cash flow because of things like the storage, the insurance, costs that go with it. If you're physically holding gold, there's security to think about. And again, some people opt for insurance. So there can be very real costs that come with holding gold from a cash flow standpoint. In contrast, if you look at a stock market overall, or single stocks or mutual funds, stocks reflect ownership in a business. That business seeks to generate profits, seeks to generate wealth, and investors who are investing their capital in these stocks, they expect to get a potential return from the cash flows generated from those businesses. So that's a contrast to how stocks operate. Stocks are slices of ownership in a company that produces something. It produces cash flows. It produces products and services. There is production behind it. So the decision to buy gold is really very often motivated by emotional responses to current events. We've seen this time and time again. We've seen this in various events throughout history. We're seeing it now. The emotional response to gold is really driven by current events. This leads to shifts in allocation, and often this can be detrimental to long-term investing, because this shifting around and moving from stocks or mutual funds into gold, because it feels like a safe haven, that emotional response to it can cause investors to lose out on market returns that follow. So we often see that, again, not a one size fits all, not always the case, but we often see that people that immediately shift to gold and market volatility, they often lose out on the returns that follow, because they've kind of gotten themselves into gold and allocate a large percentage of their investments into gold, and then they're not participating in the market when that bounce back happens, or it rebounds, or the increased returns happen. So that's something we see, something to be aware of. So often when it comes to gold, let's kind of wrap up by talking about, again, does it make sense? While I can't tell you what to do, it'd be inappropriate for me to say that on a podcast where I don't know who's listening, and it's not specific advice. I will say, here's some things to think about. When it comes to gold, often some people might be better off purchasing gold as jewelry, as opposed to coins or bullions, or even ETFs. Jewelry is something you can enjoy. It's for personal use. It's often, something beautiful. It gives you satisfaction. It can be resold. So, I mean, gold can be resold, but jewelry, often increases value because it has a utility of decoration of jewelry. So, jewelry can often be a great way to purchase gold if you want to, and also enjoy the benefits of it at the same time. Um, Ultimately, though, gold's value is really ultimately a social construct. It has value because we've all agreed as a society that it has value, and that it will have value in the future. It's an agreement in our society. So it's really just a social construct based on, the scarcity is a factor as well, and the fact that it is shiny. Um, but it's an agreement. We've agreed as a society it has value. Therefore, gold has value. That's really what it comes down to. So, can gold have a specific place in a portfolio? Can gold have a place in your investments? Yeah, maybe. Like many things in finance and personal finance, it might be appropriate for some, maybe not for others. So here is how gold can often be thought of. Gold can be used sometimes as a low or a negatively correlated asset. Gold often has low or negative correlation with stocks, with the stock market. Not always. Gold is still sometimes unpredictable, but we've seen periods where it does have low correlation, meaning when stocks go up, gold can be down. When stocks go down, gold could be up. That's kind of a negative correlation. A low correlation can also be a factor, which means that stocks will sometimes go down. Gold will either not go down as much, or maybe will hold steady, or vice versa. So generally, when you're looking for diversification, you're looking for assets that are negatively correlated, if that's what you're looking for. So some would argue that gold does provide this level of diversification, that negative or low correlation we sometimes see. While not predictable, it does have somewhat of a history of that low or negative correlation, which therefore some would argue provides diversification. If that's your goal, that can be something to think about with gold. Gold tends to thrive on bad news. When current events are negative, when things are happening, when there's wars and conflicts, legislative problems, inflation, all sorts of political and financial bad news in the world, that's when gold sometimes tends to shine, no pun intended. So gold does sometimes thrive on bad news, and therefore people again see that as potential diversification. So, therefore, all this to say, gold can sometimes reduce volatility. There are some very famous, kind of model portfolios out there built by some very famous, very smart investors that, um, are very famous and well known in the investing community. They've built portfolios that do contain gold. Sometimes they do, some investors don't. It's just kind of just a preference based on a lot of factors. But we do see some model portfolios out there that do contain some gold because it does sometimes reduce volatility. So if you're looking for reasons not to invest in gold, I think we've talked through some. The returns, the evidence of the returns don't really support the narrative of gold being a great investment long term in many cases. But if you're looking for reasons to invest in gold, there can be reasons. Again, reduced volatility, potential low or negative correlation. Those can be goals in your portfolio. And if that's the case, gold can be considered as potentially having a place there. Also, if you have a non-technical attachment to gold, I'm not going to tell you not to do it. I've seen some people that just they love the satisfaction of having gold bars in their safe at home. It just feels good. Maybe they have some sort of energetic or spiritual attachment to gold. I know some people do have that sort of alignment with the energy of gold or the energy of precious metals. Again, I'm not going to tell you that's not valid. That's something that may be important to you. So there may be non-technical reasons to have attachment to gold. Maybe there's some sentimental reason to store gold or to have gold or other precious metals based on family history. So there are a lot of reasons. A lot of this is very personal. But again, ultimately, from a technical and strategic standpoint, I want to kind of wrap up with this summarized thought. The evidence supports keeping your allocation to gold fairly small. Fairly small, what does that mean? That's not something I'm going to get too specific about, but I will say that again, the evidence really supports keeping your allocation to gold fairly small. Um, And that's from a strategic and technical standpoint. So, should you invest in gold? I don't know, maybe. That's up to you. But I want to leave you with these discussion points. You can think through it and understand how gold has behaved, the history of gold, the track record of gold, and the reasons for investing in gold and potentially for not investing in gold, and some of the use cases it can and might have. So, I find gold interesting. It comes up a lot. It's an interesting point of discussion, especially during negative news in the world and market volatility. It comes up a lot. It's interesting. It's fun to think about in terms of where it fits in. So with that being said, I'm always happy to talk over where gold might fit for you, or anything else that you might want to think about or might want to talk about. So with that, I'll go ahead and wrap up there and remind you that if you do want to talk about this or anything else we've talked about in the past, you can find me on my website, which is elevationfinancial.com. And there is a big friendly button on the homepage that says book a complimentary money session. There's no obligation. There's even a button there or a choice that says, hey, do you want to learn more about working with me? And you can say no. If you say no, I'm not going to even ask. I'll just answer your questions and say, hey, have a great day. No problem. So it's very low pressure, very low obligation. Happy to answer any general questions you might have and give you feedback. So with that, thanks for joining me today. As always, have a great day. We'll see you next time.